Anthony Grasso here, bringing you financial news that you can use. In this series of videos, I'm going to look at stocks to invest in to possibly recession-proof your portfolio. In this particular video, I'm going to do a stock analysis on Semiconductor. Now, is this chip maker worth investing in right now? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, the financials of the company, analyst projections, and I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribe and hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. Now, if you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. Okay, so ON Semiconductor is a corporation that provides intelligent sensing and power solutions worldwide. Now, its intelligent power technologies enable the electrification of the automotive industry that allows for lighter and longer range electric vehicles. It empowers fast charging stations and propels sustainable energy for the solar strings, industrial power, and storage systems. Now, the company operates through three segments: the Power Solutions Group, the Advanced Solutions Group, and the Intelligent Sensing Group segments. It offers analog, discrete, module, and integrated semiconductor products that perform multiple applications functions, including power switching and conversion, signal conditioning, circuit protection, circuit amplification or signal amplification, and voltage regulation functions. The company also designs and develops analog, mixed signal, advanced logic, application-specific standard product, and ASICs, radio frequency, and integrated power solutions for end users and end markets, as well as provides foundry and design services for government customers. In addition, it develops a complementary metal oxide semiconductor image sensors, image signal processors, and single photon detectors, including silicon photo multipliers and single photon avalanche diode arrays, as well as actuator drivers for autofocus and image stabilization for a broad base of end users in various end markets. It was incorporated back in 1992 and it's headquartered in Phoenix, Arizona. So let's go ahead and look on some of the news of the company that's going on right now. So a couple weeks ago, they reported their second quarter earnings, and they far passed the expectations. Now, I'm going to go over some of the highlights. Now, the record revenue of $2.085 billion, which was a 25% increase year over year. Now, a record GAAP and non-GAAP gross margins of 49.7%. The GAAP operating margin of 28% increased 1,100 basis points year over year. And the non-GAAP operating margin of 34.5% increased 1,400 basis points year over year. Now, the diluted earnings per share of $1.02 is compared to 42 cents in the quarter a year ago. Now, the diluted earnings per share more than doubled year over year to $1.34 from 63 cents, and 25% increase in revenue. And the last 12 months, the free cash flow margin is 17%. Now, this news definitely helped out the company, as well as the following news article that just came out a few days ago. Now, President Joe Biden signed the CHIPS and Science Bill into law last Tuesday, authorizing $52 billion in subsidies for semiconductor production and boosting funding for research. This will definitely help ON Semiconductor going into the future. And the more recent news for the company, this site will increase the firm's SiC chip bowl production capacity by 5 times year over year and almost quadruple the number of its employees in Hudson by the end of the year of 2022. Now, the expansion gives ON Semi full control of its SiC chip manufacturing supply chain, starting with the sourcing of the silicon carbide powder and graphite raw material to the delivery of the fully packaged SiC chip devices. ON Semi says that this will allow it to provide customers with the assurance of supply required to meet rapidly growing demand for the SiC-based solutions. Now, SiC is critical for enabling efficiency in electric vehicles, EV charging and energy infrastructure, and is an important contributor on the path to decarbonization. The SiC total addressable market is projected to increase at a compound annual growth rate of 33% from $2 billion in 2021 to $6.5 billion in 2026. So this is probably where the potential growth of the company is going to be in the near future. We haven't seen it specifically, but this is where it's coming from. Simon Keaton, the executive VP and general manager of the Power Solutions Group at ON Semi, he said, quote, "In addition to market-leading efficiency of our products, our end-to-end vertically integrated solution in a supply-constrained environment is a compelling and differentiated competitive advantage." Now, he said, "We have already expanded to a second building as we increased our substrate capacity and plan to continue ramping, allowing us to source our own cutting-edge SiC wafers for customer products." Now, ON Semi claims to be the only large-scale supplier of both SiC and insulated gate bipolar transistors solutions with end-to-end supply capability. During its second quarter earnings call in early August, the firm announced the $4 billion of committed SiC revenue for the next 3 years through the long-term supply agreements with the broad base of customers. It will triple last year's silicon carbide revenue in 2022 and exceed $1 billion in revenue in 2023, further emphasizing ON Semi's progress in the SiC chip space. Now, the inauguration ceremony comes only days after the U.S. President Joe Biden signed that law, the CHIPS and Science Act, into law, which aimed to strengthen supply chain resiliency and help to avoid disruptions for critical components affecting every sector of the economy. And I think this will happen. It's just going to take time. So let's go ahead and now change course and go look at some of the fundamentals of the company right now. So the stock is currently trading at $71.16 a share with a market capitalization of $30.8 billion. Now, the company is projected to have $8.24 billion of revenue for 2022 with earnings of around $2.04 billion. Now, this is where the analysts project not significant revenue increase and earnings potential in the future. They say the revenues projected to increase over the next few years to around $8.667 billion by the end of 2024, with revenues holding steady at around $2.05 billion. So with the projections of the company's management, they're saying this is going to triple demand, but the analysts haven't really updated their projections for this company. So looking at the valuation specifically analysis on this, because ON Semi is within the semiconductors industry and has positive earnings, the price to earnings growth and the price to earnings ratio is the most appropriate valuation measures for this company. The price to book ratio is excluded since it likely underestimates the company's book value by overlooking hidden assets such as intellectual property. The price to sales ratio is not as meaningful as the PE or the PEG ratio due to the company's positive earnings. Therefore, the company seems valued at a discount right now with a PEG value of only 0.89 times. That is one of the lowest in the semiconductors industry. All through their PE ratio is 17.15 times, and that's within line with the industry medium right now of about 19 times. So it's just trading a little bit below it. Now, earnings grew about 230% in the past year, but the earnings are forecast to grow, but not significantly over the next few years. Can this new facility that we just talked about change the analyst projections coming up in the near future towards the end of 2022 and 2023? Maybe. Now, let's look at the price, the share price versus fair value. When looking at its future cash flows, for this estimate, we're going to use the discounted cash flow model. And when the company is trading below the estimated fair value that we put around $94 a share, looking at the future cash flows. Let's look at how profitable the company is. So the company is one of the more profitable companies in the semiconductors industry. Its operating margin is among the strongest of any of its peers, while the net margin is above the industry median. And the current net profit margin of 22.6% is higher than the last year, which was 8.8%. Now, the company doesn't pay any of its dividends. However, the average yield on those stocks in the semiconductor industry that do pay dividends is about 2.76%, better than the 1.91% yield offered by the S&P 500. Now we got to look at what about the growth of the company. Now, earnings growth at this company outpaced revenue growth over the trailing 12 months. This is a trend that is not sustainable if profits are to continue to grow at this rate. However, the result was better than that of the average company in the industry. And finally, let's look at the financial strength of this company. Now, the debt to total capital ratio is 37.52%, which is in line with the industry's norm, with the interest coverage of around 33%, 33.2% times, or 33.2 times, and a quick ratio of 1.88 times. The company should be able to comfortably repay its debt. Okay, so what do the analysts say specifically regarding this company? So the average price target on Semiconductor over the next 12 months is $74.38, with a high of $82 a share and a low estimate of $55 a share. They have a buy recommendation on it. 57% have a buy recommendation. So let's go over a few of the analyst reports real quick. So let's first go over the street quant ratings. They have a buy recommendation on Semiconductor. This is driven by a few of their several positive factors, which they believe will have a greater impact than any of the weaknesses and should give investors a better performance opportunity than most stocks that they cover. Now, the company's strengths can be seen in multiple of areas, which have robust revenue growth, solid financial position, and reasonable debt levels by most measures, solid stock performance, impressive record of earnings per share growth, and compelling growth in net income. They feel that the strengths outweigh the fact that the company shows weak operating cash flow. All right. So the Ford Equity Research team over here, they currently have a hold recommendation on this company, and as a result of their systematic analysis of the three basic characteristics that they look at. They look at earnings strength, relative valuation, and recent stock price movements. The company has managed to produce neutral trend in earnings per share over the last 5 quarters, and while most recent estimates for the company have been raised by analysts, the company has posted better than expected results. Now, based on operating earnings yield, the company is undervalued when compared to all the other companies that they cover. Now, they said, quote, share price changes over the past year indicates that the company will perform poorly over the near term, and I'm going to get into that as well. But first, let's look at the last report. Now, the CFRA report, they have a buy recommendation on the company as well. They like that the company's exposure to the industrial and automotive end markets, recently 66% of its revenue, which should support profit margins, better growth opportunities. Now, with a healthy macroeconomic backdrop and a better operational cost structure, the company can improve its profitability and returns. Now, the CFRA remains optimistic about content gained potential within the automotive space, with a strong presence in the China EV market, and think pressure from activists in the company will ignite management to execute new strategic initiatives that will yield greater shareholder value. Now, the company remains in a supply-constrained environment right now, as end demand remains robust and customer inventories are depleted, supporting longer lead times and strong revenue visibility. Let me bring it back over here. So based on all of that information, am I a buy, hold, or sell recommendation on this company? Well, here are my thoughts. Now, the company currently has a really strong turnaround potential with this new facility, this new SiC chips. They have a superior product with that SiC chip. They have exposure to hyper growth trends in electric vehicles, automotive space. The company has an outstanding track record with a flawless balance sheet, as we can see. I am impressed with the company's positioning in the silicon carbide, or that SiC chip, for the automotive applications. Now, it is on track to become the leader in the silicon carbide chips. Those next generation chips will lead to oversized growth and increased profitability, potentially. The company does have a strong turnaround potential. It does have a superior product with the SiC chips and exposure to a hyper growth trends in electric vehicles. Now, the company has an outstanding track record with a flawless balance sheet. Now, I am definitely impressed with the company's positioning with the silicon carbide, or that SiC chip, for the automotive applications. Now, it is on track to become the leader in the silicon carbide chips. Those are basically the next generation chips that will lead to oversized growth and increased profitability potentially. So that's where the risk is. I do feel the company specific driver behind the company's SiC chip demand is its technology differentiation. The customers are able to develop systems with longer battery life and range using the ON Semiconductor's solution. Now, we all know that the mile range per charge is currently a paramount metric for the electric vehicle makers. Now, the company, though, is exposed to weakened consumer spending right now in its PC and consumer related markets. Now, expect demand in the automotive industrial end markets will also moderate in the coming quarters as customers' orders are normalized. But, that's going to be, 6 months down the way. So based on all of that, I am a hold recommendation on semiconductor right now with only a 12-month price target of around $70 a share. But let me explain. I would put this one on my watch list first and buy the next dip and look at a buy point of around $60 to $65 a share and hold for the long term. Everybody that got into the market right now on all that good news is going to probably take some profit sharing. And if you look at the historical price of this company, it definitely has its ups and downs. So look on the next dip, but buy in the $60 to $65 range. Now, for a long-term strategy for growth, the real question is whether or not those next generation chips will lead to oversized growth and increased profitability. Now, that's possibly, but is yet to be seen. The analyst projections have revenue growth just slightly increasing and earnings remaining almost stagnated. Now, while I'm an optimist about the company's position within the power management market over the next few years, I believe that the company could experience incremental headwinds in the near term. Hence why I'm a hold position to buy the next dip of around $60, $65 a share. As of right now, I would put this in the category to help recession-proof your portfolio. And if you want to roll the dice long-term for that potential growth opportunity, then it might just pay out in the end for you if you buy and you hold on and don't worry about the dips and you just keep it and you run with it for the next 5 years. Now, risks to my current recommendation and target price include worsening macroeconomic conditions, slower recovery from the lower cost structure, and increased competition supporting lower prices and margins if there's some other high-end chip that comes back on the market and outdoes their chip that they're making. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.